Hello, and welcome to this week's show. Thanks so much for joining us today. I'm your host, Trey Winowitz, and you're watching Right on the Money. Our goal for the show is to always equip you, the viewer, with accurate financial information so that you can make educated decisions for both you and your family. We've got a great show lined up for you today, so thanks for watching. We're going to be tackling some difficult financial questions, and we want to take some things that could be somewhat complicated and make them simple and easy to understand. So come on in and have some fun with us.
In the aftermath of Hurricane Katrina, Trey Winowitz was forced to move himself and his family over 600 miles north and begin his financial planning practice again, from scratch. Since then, Winowitz Financial has become a national success story, establishing itself as a trusted source for financial advice in and around East Tennessee. In return, Trey gives back to the community by sponsoring monthly educational workshops and annual charity events. He also hosts a weekly radio show informing and entertaining those in need of financial advice. So, if you'd like to understand more about today's challenging financial environment, if you'd like to overcome your current financial situation, and want to learn from someone with a track record of overcoming, stay tuned for some trusted financial advice that's right on the money.
Now let's get to our main topic, fact and fiction of paying off your home. For the last few years, interest rates have been falling pretty dramatically. When people come in to see me at the office, I frequently notice this in their savings account interest. A few years ago, you could make about 5% on a CD even. Now you're lucky to find 1%. Along with this drop in interest rates on savings accounts, mortgage rates have continued to fall also. This has forced the average consumer who owns a home to try to figure out if it makes sense to pay off their existing mortgage sooner. The impulse to pay off your mortgage quickly is understandable, especially these days. Interest rates are near historic lows, so it's possible to replace a 30-year mortgage with a 15-year and still afford the monthly payments. Or if you've already refinanced at a dirt cheap rate, you can take those savings and pay your principal down even faster. But is the allure to pay off your mortgage more emotional than financial? Structuring your mortgage debt properly could provide great financial flexibility, and paying down fast might not be the best way to go and to grow your nest egg. Greg McBride, a senior financial analyst at Bankrate.com, says that generally speaking, there's no advantage to paying down a mortgage earlier than you need to. When your mortgage interest rate is low, paying less every month gives you a chance to reinvest the savings in other productive ways, like paying down higher interest credit cards or saving for retirement. Now, when it comes to financial decisions, people always want to make a wise choice in what they do, and they want to understand their options. So on today's show, we're going to dive into these topics.
Are we wearing life vests?
No. When should you consider refinancing? How much does it really cost to refinance? What's the most efficient way to pay off your house? All right, now we've got to take a quick break. I hope you can stick with us. This is going to be a great show. Stay tuned for more trusted advice that's right on the money. Thanks so much for joining us. I'm Trey Winowitz, and you're watching Right on the Money. If you're just tuning in, we're talking about the facts versus fiction of paying off your home. Before we broke, we talked about whether or not the desire to pay off your mortgage quickly is a financial decision or an emotional one. Now let's take a look at some options when it comes to refinancing. Lately, people have wanted to refinance more often to pay off their home sooner. With rates at a historical low, sometimes people can even take a 30-year mortgage all the way down to a 15 and not increase their payment. Another very valid reason to consider refinancing is if you have other high-interest, non-deductible debt. By consolidating this into the primary mortgage and continuing to make the same payments, you can accomplish your goal in a far shorter period of time. And finally, some people consider refinancing in order to use some home equity in their home for updates and renovations to enhance the value of their home. My advice is just to be careful. Depending on the rate and the terms, this may make sense, but you want to be careful when you have to borrow money to do the renovation. If you can pay cash for some of the upgrades, sometimes that might make more sense. So let's go over something that's very important to everyone out there who has a mortgage: the actual cost of refinancing in today's market. Now, the average closing cost on a $100,000 loan, the total closing cost would be approximately $2,215. Now, the origination fee will vary slightly depending on the loan size, and generally it's around 1 to 2%. So let's say that's another $1,000. Here's a little known fact. In most cases, you can cover a significant portion of that fee with a credit from the lender, so the borrower, you, don't have to pay it. The general fees involved are these: the underwriting fee, the appraisal fee, the title and closing fee, and taxes. Now, the difference between a lender-paid transaction and points is on a lender-paid loan, the lender will credit a percentage of the loan amount back to the borrower. This helps cover the closing cost and prepaid items based on the interest rate chosen. On a borrower-paid loan, the borrower is responsible for any and all closing costs and prepaids. This is normally done by raising the loan amount to cover these costs, or by covering costs by raising the interest rate, or a combination of both. If this sounds a little bit confusing, give us a call at the office. We can look at your case individually, sit down, and help you make the best decision for you and your family. A little later on the show, I'd like to tell you about an efficient way to pay off your mortgage, because people are always asking me, "Trey, what's the best way to pay off our house early?" I'll tell you, it depends on a lot of different factors, and ultimately it's a decision that you and your family have to make. Well, I'll finish this segment out by explaining the main two ways that people do it. Then I'm going to share with you what I might recommend and why. But before I talk about that, I'd like to tell you about some other things you need to make sure you take care of first before paying down the principal of your mortgage. I want you to consider doing the following things first. First, pay down all high-interest debt like a credit card. It's the biggest priority because it's very expensive debt and has no other tax or financial benefit. Then, build a cash reserve or cushion to cover unexpected expenses or loss of income. Next, build up your retirement savings by putting in the maximum amount allowed by law into a tax-sheltered plan like a 401k, 403b, or IRA. This also reduces your taxes. Then you may want to consider funding a college education plan such as a 529 plan for your children, especially if you live in a state with income tax. These programs shelter money from the state and local income taxes. Once these priorities are taken care of, the next step is a matter of preference. Now, we've got to take a quick break now, but when we come back, I'll talk about the two main ways that people pay off their mortgage, as well as the way that I recommend. Stay tuned for more trusted advice that's right on the money.
Executive Lending Group is a local independently owned mortgage company committed to providing you with high-quality financial services, as well as the lowest rates available in today's market. Chris Holgroff is a mortgage professional who will work with you one-on-one to ensure your mortgage is tailored to meet your specific financial needs. His 12 years of experience in the industry will help you find the right loan program at the lowest rate.
Call me anytime at 865-257-7777. We look forward to working with you.
Thanks so much for joining us. I'm Trey Winowitz and you're watching Right on the Money. If you're just tuning in, we're talking about the facts and fiction of paying off your home. We've talked about whether or not it's an emotional or financial decision and what you need to do first. We've also talked about the cost of refinancing. Now let's go over the two main ways that people pay off their mortgages. Number one is taking a shorter term mortgage. One option is to simply choose the mortgage with the shorter amortization schedule. Now, this is going to make the payment higher because the debt's going to be paid off in half the time. But it's also going to save the homeowner interest that they're paying. For example, if you have a $200,000 loan at a 15-year fixed rate, let's say in today's terms that rate is 3.125. This makes your monthly payment $1,393 a month, and your loan would pay off in 15 years. Then there's the strategy to pay an extra principal payment annually to pay the loan off earlier. Let's look at what that looks like. So if you pay one extra payment per year on a 15-year fixed option, you'll have your 15-year mortgage paid off in 13 and a half years or 163 months. Now if you do the same on a 30-year loan, you'll have your 30-year loan paid off in 26 years or 313 months. So my tip is always allow for flexibility. What if you combine these two? Do you know what would happen that if instead of taking the 15-year loan, you took a 30-year loan and just made the 15-year payment? That's the difference between the two payments, putting it towards the principal on a 30-year loan. Let's take a look at what that looks like and the benefits that it could offer you. So here are the figures that we've run for you based on that same $200,000 loan. A 30-year fixed rate at 3.75, your principal and interest payment would be $926 a month. The 15-year fixed rate at 3.125, which is usually a little bit lower rate, the payment would be $1,393. So on the 30-year mortgage, if you make the 15-year payment of $1,393, which is applying additional principal of $466, each month, you'll have the 30-year mortgage paid off in full in 191 months or 15.9 years. So here are some reasons to consider my tip. If you ever have a financial problem, you'll have a smaller obligated payment. If there's an unexpected death, divorce, or job loss, the smaller obligated payment gives you a whole lot more flexibility. Even if you had to stop the extra principal payments temporarily, you could always restart with little effect on the ultimate goal of paying your mortgage off sooner. I believe that this method gives you the most protection for the what-ifs in life. So the bottom line is this: everyone's situation is different. You want to sit down with a qualified professional and look at all your options. Give us a call and use our friends and family discount when you purchase a house or refinance your mortgage. I'd like you to personally sit down with me and let us help you choose the best mortgage plan for you and your family. Well, that's all the time that we have for our Money Talk segment. Coming up after the break, we'll learn how people just like you benefited from a no-cost second opinion. Don't miss our Money Matters segment. We'll see you in just a second.
Are you looking to recruit and retain great employees? Would you like to reduce your retirement plan cost? Now you can offer employees the opportunity to keep their retirement funds protected and growing. Separate yourself from your competition. Make a difference in the retirement of your employees with little to no additional cost to you and no change to your TPA, payroll, or existing 401k company. Call Winowitz Financial today to find out more about this exciting new product.
Now that we're back, I'd like to tell you about some real-life folks that you can relate to, because it never hurts to have an extra pair of objective eyes take a look at your situation and see what can be improved. But sometimes not getting a second opinion can be very costly to your family. Even if the strategies you're using can't be improved on, people say it's a huge comfort when I tell them that what they're doing is working well for them and they should continue with that plan. However, in some cases they discover that products or strategies that they thought worked a certain way actually don't work that way. So what I want to do is take a second to introduce you to a few people who came in my office recently for that no obligation second opinion, just to be sure. And these folks are glad that they did. If you'd like to be a part of this Money Matters segment, please give us a call at the office and schedule a complimentary review. Now let's take a look at this week's case. Jana, can you bring me my notes?
Sure.
Thanks. This week's case study comes from Knoxville, Tennessee. We actually had an 80-year-old retired engineer. His wife was 81, and she actually was a retired school teacher. They came in after watching our television show and then signing up for one of our monthly educational workshops. Main concerns for this case: they had a lot of CDs, and over the years they had had some really reasonable rates on them. Of recent, the CDs were renewing. They were really, really low, looking for better alternatives for their interest, but also wanting to keep their money liquid. They weren't sure what to do with their RMDs. This is the required distributions from their IRAs that they were forced to take. Lastly, they had some concern about preserving their assets. They wanted to pass it on to their heirs very efficiently and weren't really using a lot of the assets that they had accumulated, so they wanted a distribution and a preservation plan. Steps to success. We took some time, analyzed their current situation, talked a lot about what their goals and their needs were for the money and what it was for in the future. We also took them through our annuity fee sheet. They had a couple of annuities that they had purchased years ago and did not realize the amount of money that they were paying in fees. We researched other alternatives that had no fees and were a little bit safer, and then we also shopped some guaranteed rates and some other liquid alternatives to improve those returns on the CDs. The results were these. We were able to find them some really good short-term guaranteed rates that paid some good rates, some good dividends, and kept their money liquid, which is what they wanted. Also, we discovered on some of their annuities, they were paying over 3% a year in fees and had no idea. So we were able to find some better alternatives that we could eliminate that fee that they were paying every single year. They didn't have to put their money at risk to make a return, and their money was way more efficient. Also, we were able to reposition some of their managed money accounts. They had some money still in the stock market, which they were good with, but we actually repositioned it to some of our managers who had a proven track record of helping avoid downturns in the market. This was very, very good and helped accomplish their goals of leaving more money to their heirs when they passed. Give us a call today for a complimentary review, and if your scenario gets picked for the show, you're going to receive a Right on the Money prize pack. But most of all, we want to help you. Coming up next, another opportunity for you to be a part of the show. Post it on our Facebook, tweet us, or email us your financial questions, and stick around for the viewer mail section.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
For the last few years, it's been harder to make a consistent return on your money. Are you paying too many fees? Could you get cheaper life insurance rates? Could you pay less taxes? Join the hundreds of others that have dramatically saved money using a free fee analysis. That means you've got to make sure your money is working efficiently for you. Call Winowitz Financial today, 691-2433. That's 691-2433, and start saving money today.
Welcome back to Right on the Money. I'm your host, Trey Winowitz, and it's time for you, the viewer, to be an integral part of this show, Viewer Mail. This is the part of the show where you send us your questions about anything financial. In order to get your questions to me, you can post them on our Facebook page, tweet your question to me at TreyWTV, or email them to me at advice@TreyWTV. If your question happens to get answered for the show, you'll receive a Right on the Money prize pack just for your willingness to help out our other viewers. This package has a retail value of over $50, so please don't stop sending us those questions. Our first viewer mail question today is, what is a market index? Once you decide which index is appropriate for you, if any are, You can invest directly into a particular index, but a lot of people come into our office, what they realize is you can put money into accounts that follow a given index. For a more conservative investor, this may be a great choice. You give up some of the potential gains of that index, but you get the protection and safety of your principal and any interest you earn. These products can be purchased from an insurance company or on a bank platform. They come in CDs that are FDIC insured, and as well, they have a minimum guaranteed interest rate. But when considering any investment, please sit down with a qualified professional. Also, make sure they're licensed to give you financial advice in all areas. Otherwise, the advice that you get might be a little bit one-sided. Thanks for the question. And our next question is, what are asset classes? You know, there are also other types of investments like real estate, precious metals, and annuities that you may want to consider. But be careful when you talk to advisors that recommend a whole bunch of different types of mutual funds without really offering you anything else. This is very, very traditional advice, and it simply spreads out your risk. In today's market environment, you want some of your risk eliminated. In order to do that, we might need to look at some things that they're not showing you. Thanks for the email. Keep them coming. The last question we have time for today is this. How much life insurance do I need and what type should I buy? You know, this is a great question and it differs from person to person and depends on a lot of different factors. Usually, people carry more insurance when they're young and have more debt to replace their income. Most advisors recommend 6 to 10 times of your income, but you may not quite need that much. If you're shopping around, make sure that you use an independent agent. They'll be able to shop multiple companies based on your individual situation and help find the best fit for you. Give me a call at the office and we can sit down and go through this question specifically to you. Also, if you have any other financial concerns or questions, before you come in, please make sure you watch our life insurance show. I'd be happy to send you a free copy of that DVD just for sending in your question. Thanks a lot and keep them coming. Stick around after this short break for Right on the Street. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know.
Are you planning for retirement? Which path should you take? How can you avoid mistakes? What about a second opinion? Get sound advice for today's market. Make sure your future is secure. With principal protection, reasonable returns, simplicity and safety, call Winowitz Financial today to schedule your complimentary financial review at 865-691-2433.
And we're back. This is Right on the Money, and I'm Trey Winowitz. See what some local people just like you think about the stock market and other financial topics. You may actually see someone that you know.
Dire Straits. In the 90s, they had a great song. They said, that ain't working. That's the way you do it. Money is for nothing, and...
These are my kids. This is Carter.
All right.
Can you sing it for me? That would be more helpful. Why don't you
That
sing
ain't
it?
working.
No, that's not singing.
Money for nothing.
Something for free.
It's called a baby chicken.
Oh, chicks.
There you go. All right. Bill Gates. Pretty wealthy man, wouldn't you say?
Yes.
Almost as wealthy as Nick Saban, right? How much money would you guess that Bill Gates made last year? Well, Bill Gates, as you probably know, he makes a lot of money.
Yep.
How much money do you think Bill Gates made last year? Any guesses?
Several billion.
It was definitely over $1 million. Or how much money would she guess that Bill Gates made last
Oh,
year?
how much money would she get? Oh, 25 billion.
It was in the billions.
Oh, really?
I don't know, maybe 5 billion.
Yeah, studies say anywhere between $3.5 and $5 billion last year. That's pretty amazing.
That's pretty good.
So Dire Straits, they're a band from the 90s. They said, they had a song about money. They said, that ain't working. That's the way you do it. Money is for nothing, and
Something is for free.
that's right. It's a baby chicken.
Chicks.
Very good. Yes, that's awesome. Now the Beatles had a couple of songs about money. One of them was Penny Lane. You're in my ears, and you're in my what?
Heart?
lot of people have said heart.
Yeah.
Mine?
A lot of people have said mine. Your sunglasses are covering them.
Eyes.
Eyes, very good.
I knew it was
That
something with
good.
a hard eye.
I know you've heard the Beatles, right? The Beatles?
Yes, yes.
They said that I don't care too much for money, but money can't buy me.
Love.
Oh, you do. That was money right there. Bruno Mars, you've heard
Yep,
of Bruno Mars?
got that one.
Okay. He wanted to be a billionaire. Really, really
So
bad.
freaking bad.
Right.
Yeah.
He wanted to be on the cover of Forbes magazine, smiling with who?
Oprah?
And
Oprah and the Queen.
there you go.
Yes.
Very
That's
good.
right.
I was singing
Very
it in the
good.
head.
Very good. Dolly Parton, she's a local celebrity. She talked about the type of long hours that people needed to work in order to make a living. And it was working something, working when, in order to...
9 to 5.
Very good.
And we're back. This is Right on the Money, and I'm Trey Winowitz. We're just getting ready to wrap up the show, but before we go, I'd like to tell you about an old Louisiana tradition called lagniappe. Lagniappe means to give someone a little something extra. And the way that we want to do that here at Right on the Money is to brighten your day at the end of our show. So with that, here's a little lagniappe for you. So 3 leading economists took a small plane into the wilderness to hunt moose over the weekend. The last thing the pilot said was, now remember, this is a really small plane and you can only bring 1 moose back. But of course, they all killed one, and come Sunday, they talked the pilot into letting them bring all 3 dead moose on board. So just after takeoff, the plane stalled and crashed. In the wreckage, one of the economists woke up and looked around. He said, "Where are we?" Another one quickly answered, "Oh, we're about 100 yards east of the place we were last year." The moral of the story is this: consistent bad economic advice gets you to the exact same place. And that, my friends, is a little lagniappe for today. I want to personally thank you for watching our show today. I hope you found our show helpful as well as a little bit entertaining. If there's anything at all I can help you with financially, please don't hesitate to call our office. And remember, any plan that we come up with will always have 3 main goals for your money. Safety first, or protection of your principal, is always number 1. Making a reasonable return on your money in what some would consider an unreasonable market. And number 3, keeping your plans simple and easy to understand. If that sounds like something you want, I know I can help you. Also, please keep the financial questions coming. We'll do our best to get them answered on the show. I'll see you next week at 3 o'clock for more trusted advice that's right on the money.